Hi, I'm Andy Webb from BeCleverWithYourCash.com. Welcome back to my YouTube channel. If you haven't already subscribed, please do, and hit that notification bell as well, because that'll make sure you don't miss any future videos. Now, in this video, what I'm going to do is talk you through the idea of overpaying on your mortgage. Okay, this fantastic sort of idea that potentially you could be mortgage free much earlier than you want and potentially help you on that path towards financial independence. So what I'm going to do is ask whether you should be doing this, is it a good idea, and also how you'd go about doing it as well. Okay, let's start off by going back to basics and just sort of breaking down what exactly a mortgage is. Okay, when you're buying a house, exactly where your money is going. So obviously to start off with, you're going to need a deposit, aren't you? Most people, they're going to save up 5-10% of some money first of all, and that acts as, that's what you call the deposit. But essentially what that also is the start of your equity. The equity is basically how much of that property you own. Okay. Now the next part of a mortgage is that mortgage itself. It's the loan, isn't it? That's how much you are borrowing in order to afford that really expensive thing, which, let's face it, most of us are never going to be cash buyers. We don't have that amount of money laying around. Though, of course, if you are downsizing from a bigger house to a smaller house, maybe then you've got that flexibility, or you're moving from an expensive part of the country to a smaller part of the country, or you're just plain rich. Okay, whatever those ways. But most of us, we're going to have those two parts, aren't we? We're going to have the deposit, which is the start of that equity, and we're also going to have that mortgage loan. But there's also a third part that comes into this, and that is the interest, because every single mortgage loan you are charged interest on. So when you are making a payment every single month, you aren't just paying off that loan to build that equity. That money you pay off, that mortgage payment, also goes off to pay that interest. And actually the way mortgages work, to start off with, you're paying a lot more interest than you would be later on. Okay, so that's what's going on. Now there are a couple of other factors to throw in there as well. There's the mortgage term. That is how long you have borrowed that total amount of money for. Now, generally, that's 25 years, okay? That's what most people go for. It's a standard one, but you can get longer. My first mortgage, when I bought my first property, that was 30 years. I wanted that a little bit more time. The reason for that is it meant the monthly payments went down. I had a bit more flexibility, and I'll get into that later on. But also you can have shorter. Something else to bear in mind as well is how long that mortgage you have is for. Because although you're borrowing for a term, a longer amount of time, you might only have a particular mortgage deal for a short amount of time. It could be, say, a 2-year fix. It could be a 10-year fix. It could be a tracker, which follows the rate of, say, the Bank of England base rate for the entire length of the term. All sorts of different ones there, but they all do come into play in terms of how much it's going to cost you to pay off that mortgage. Now, obviously, the very simple principle here would be, the more you pay off every single month means the quicker you pay off that loan, doesn't it? And the sooner you build up that equity and you clear it, fantastic. And I'll get into some of these pros in a bit more detail in a second. But you need to think before you just jump into that, if you've got some spare cash laying around, before you jump into that, there are some other alternatives which might be a better use for that money. First of all, have you got any other kind of debts going on? Credit card debts, for example, or maybe some personal loans. Now, it's a very good chance, particularly with credit cards, is the amount of interest that you're getting charged on those ones is going to be a lot higher than the interest you're getting charged on your mortgage, which means it's going to be more expensive. So let's say you've got £1,000 on a credit card at 20%. Now, doing £100 every single month for 10 months to clear that is going to be saving you a huge amount more money than it would be putting £100 into your mortgage, extra into your mortgage every single month for that same 10 months. It makes much more sense to clear that credit card debt first of all, okay? The other thing you need to think about once you've cleared your debts is, do you have any savings? Now, I'm not talking about vast amounts here. I'm talking about an emergency buffer. That's the most important thing you need to be thinking about. If you've got some money which you're considering using to make overpayments on your mortgage, but you don't have an emergency savings buffer, you need to be prioritizing that first of all. Because let's say you lose your job, or you're too ill to work, something big like that, okay? All of a sudden, if you haven't got any emergency savings, you're going to have to borrow money. You might not even have money available to pay the mortgage. It's much, much better to have a lump of cash built up in those scenarios. And also it means it's there if something like, the dishwasher breaks or your car fails the MOT and you need some new tyres. You've got a little bit of money to dip into to cover those expenses again without borrowing. Now, the general rule of thumb here is what people often say is 3 months of emergency savings is what you should be aiming for at least. That means you're covering your essential outgoings for 3 months while you hopefully find a new job or get back on your feet, you get well enough to work, whatever it might be. And of course, there are insurance, protection insurance policies you could look at which help you with similar situations if you can't work. But in principle, even as well as those kind of things, have that emergency buffer available for at least 3 months if you can, okay? And just put that extra money you have into that as a priority. So clear those debts, build up an emergency buffer. Then, if you've got any money left over, you need to think about what rate you can get from further savings. Now, the fact is, if you've already got some emergency buffer built up, you're going to probably maximize the best interest rate deals out there on savings. Now, these change all the time, but as a whole, they're not fantastic right now. So the odds on that you're being able to then get a decent amount of money once you've saved up enough of those emergency funds, whatever that is, to then also get an account which is offering you an interest rate in savings that is better than the amount of interest you're paying on your mortgage are quite low, but it's not impossible. So do check that first of all. Find out whether you can make more money from putting your money, this extra cash, into savings rather than paying off the mortgage. Now, another argument that comes in here is that idea of overpaying your mortgage versus investing in the stock market, in stocks and shares. Now, over time, generally, it does seem that the returns that you're going to get from the stock market can be, cash returns and can be necessarily the interest you'll be paying on your mortgage, but it's not guaranteed. And you have to kind of know what you're doing here. So if you're someone who already understands and regularly uses the stock market and you're comfortable with your investments and how you're doing that, you might feel that is the best thing for you to do rather than overpaying on your mortgage. However, the other side of looking at it is you might feel that although the investments can go up and down and you might lose some money, you might make some money, but you personally prefer the idea of getting that mortgage out of the way and knowing that it is gone and it's cleared, because whatever life throws at you, if your mortgage is cleared, you do have a greater amount of flexibility. So that's something to bear in mind. I'm not going to tell you which one of those is the best thing to do, whether it's pay off your mortgage or invest in the stock market. It very much is an individual choice and maybe something you want to look into a bit more. Personally though, what I'm going to be doing right now is I'm going to start overpaying on my mortgage again. Now, for the first 8 years that I had a mortgage, I was overpaying every single month. I had quite a low mortgage. It was just about 600 quid every single month. And I was able to overpay by an extra £200, 250 quid every month as well. And I did that pretty much for 8 years. Now, when we moved house, not only did we sort of get a slightly bigger house and an extra mortgage, but also we had a lot of work that needed to be done on it. So we needed our cash much more. So I haven't been overpaying on the mortgage for the last 2 years, but everything's pretty much done on the house now. So I've got more money spare every single month. So I'm going to be prioritizing overpaying my mortgage. And there are a few reasons for doing that. Now, the most obvious one, as I mentioned a few times already, is that sense that you will have paid off your mortgage sooner. The more you put into it, the faster it's going to be cleared, which is fantastic. And it gives you all that flexibility and that freedom that you can have later in life by knowing that you are going to not have a mortgage payment every single month that you need to make. So that's obviously one that attracts most people. And this idea of financial independence, which is becoming more and more popular here in the UK, this is probably one of the biggest elements of financial independence, because you don't have to rely on anyone else. You can retire early if you want to. If you can't do that, you can at least reduce your hours or reduce the days that you work. Maybe get a job that doesn't pay as much, but something you enjoy more, because you don't have at the back of your mind always nagging you the whole time knowing you need to be able to pay the mortgage every single month. Yes, you're still going to have to pay your bills. Yes, you're still going to want money for going out and doing things, but it gives you so much more freedom. And it's something that I really like the idea of, and something that I definitely want to build to. If I can clear my mortgage in 10 years from now, then that would be absolutely fantastic. And that would mean that I've cleared it in 18 years rather than 25. And I would be absolutely delighted with that if that's possible. Now, the next thing is also really, I think probably, if you think about it, one of the bigger motivators is when you overpay on your mortgage, you're obviously clearing it sooner, aren't you? Which means you have that debt for a short amount of time, which means you're getting charged interest for a shorter amount of time. And this can be really quite significant, these sums. I've got some examples here. I'll give you an idea of what they could be. So let's say you owe £150,000. You've got 25 years left on that mortgage and you're paying 2.5%. Okay, let's just say that's relatively typical. You obviously could have a longer term, a shorter term. You might have been paying it off for 10 years. You might be living somewhere much more expensive, let's say in London or the South East, where property prices are massive, so the amount you owe is bigger. You might have a higher, lower rate. But this is just a good example to give you an indication of quite how much difference overpaying can make. Now, if you have that mortgage, it means you're paying £673 every single month. And the total interest that you will get over the whole 25 years is £51,000. Okay, so that's a huge amount of money that is being charged over that time. Okay, a lot of money extra in interest. Now, if you can overpay by £100 a month every single month, then you would clear it 4 years early, which is nice. So in 21 years rather than 25 years, and the saving, the amount of interest you would not be paying by making these overpayments is £9,000. That is, I think, to save £9,000, fantastic. Yes, you won't necessarily see it in one lump sum, but you will over, say, that 21 years, you'll be £9,000 better off, which is lovely. Let's say you can put a little bit more into this example mortgage. Let's say you can put in £500 every single month. Now that might be a bit of an ask. You might think that's a bit too much money, but if you can pay £500 extra every single month, you clear it in 12.5 years. You're cutting the amount of time you have a mortgage by half, and the amount you save, £27,000. Amazing, isn't it? Now, again, you might be thinking, oh, 500, that's a bit much. I'm not sure I can find that money. But when you look at those sort of figures and those timings, you might actually have a bit of a greater motivation to try and find those savings, try and find ways to get a little bit of extra cash every single month. The idea of having a mortgage that lasts just 12.5 years rather than 25 years, and to be over those 12.5 years, £27,000 better off. Amazing, right? Or this is just a much more extreme example, right? I know most of you won't have an extra £1,000 just laying around every single month, but if you could pay off an extra £1,000 on your mortgage every single month, you would save £36,000 in total, and you would clear it in just 8 years. So I think that to me is really exciting, this idea of if you had the cash, how much you could overpay, how much money you would save and how much faster you would clear it. I think that's fantastic. Obviously, there's a lot of assumptions going on there. It's assuming that 2.5% is what you would have for the entire time. That could change. Obviously, interest rates can go up and down every time you remortgage. You might not be able to get a better deal. You might get a more expensive deal. It really depends what the base rate is doing, which is set by the Bank of England, and then how the lenders respond to that. But that is I think is a very, very, very kind of exciting thing to think about. Now, if you did want some kind of certainty in terms of making sure that you know exactly what the interest is going to be every month, what your monthly payment's going to be, and how much you can overpay, you could look at a longer fix. So fixes generally seem to be sort of around 1 year, 2 years, 3 years, maybe 5. You can get longer fixes. You can actually even get like a 10-year fix. So when I've got my mortgage, when I moved house, I had the existing mortgage, which is a base rate tracker. I transferred that, I ported it, it's what it's called, to my new property. The new property was slightly more expensive, so I had to get out another mortgage with the same lender. Now that one, I actually went for a fix. I did go for a 10-year fix because I was confident that the amount of money that was in there, it was obviously a smaller amount than the main amount I borrowed. The small amount in there, that I could clear that in that 10 years with overpayments. But I would be guaranteed to know exactly how much money it was going to be. Now, maybe I would have overpaid slightly on that, because if I'd got a shorter fix with a lower rate, and actually things haven't changed too much, rates are still very, very low, maybe I could have remortgaged to another shorter fix, and save money over time. But what it's given me is one of my mortgages, that fixed, that tracker, that could go up and down, but this fix gives me that surety. I know what's going on. So that for me means I'm hoping to clear one of them in 10 years, and the other one, overpayments, maybe around the same amount of time, depending what's going on with my money. But those figures, they show me that fantastic. That is a huge amount of motivation, I think, for me, and hopefully for you too, in terms of doing it, just in how much money you can save. But even if you haven't got those larger amounts of money to put off to clear, essentially in such a quick amount of time, even small amounts of overpayments can make a big difference, not just in the time and the amount of interest that you pay, but also when it comes around to remortgaging. Now, this is something that's really, really important, because as I mentioned, you may well be on a fix, or you might be on a variable rate tracker, whatever it might be. But when that deal that you've got, when that finishes, when that comes to an end, the best thing to do is to shop around and get another deal. Again, it could be a short term, it could be a longer term one, whatever it might be. And you want to try and obviously when you get a new mortgage, when you remortgage, you want to get the lowest rate possible. Now, shopping around is a big part of that. But what will give you an even better chance of lowering that rate is to increase what's something called the loan to value of your mortgage. Now, at the top, I talked about the different aspects of the mortgage. I talked about the equity, the deposit becoming the equity, yeah? And then you've got your loan. And that's essentially what loan to value is. Now, you'll see this when you're looking at the different offers. It will say 90%, 80%, 75%, down to 60%. And that is how much money you are borrowing. That is the loan percentage to the value of the property. So you are borrowing, if it says 90%, you are borrowing 90% of the value of the property. Now, the reason I talked about in firm percentage there is because there are certain bands. It doesn't drop from 90% to 89%. It drops from 90% to 80 or to 75, like I said, in those different brackets. Now, but you need to move between those brackets because every time you do that, and when you come to remortgage, you can say you've suddenly got an increased loan to value, a better LTV, and that means you can get access to better rates because every band that it drops down, the rates tend to fall. Now, the very bottom line here is 60% LTV, which basically means you have got 40% of the total value of the property and you're borrowing 60%. So that means, you know, that's as far as you can go. It doesn't make a difference after that, really. If you've got 50% equity, you're still going to get essentially that 60% to 40% set of offers, but it can make a big difference. And obviously, if you are able to move down by overpaying on the mortgage, because obviously you're making the payments anyway, your loan to value is going to happen, but overpayments help you move there quicker, help you move between those brackets faster, and that means you get access to the cheaper deals, and that means you are going to be paying lower interest, which means overall the amount you pay is going to be less again. So that's another fantastic one which people think about. So even if that idea of clearing it, you know, really fast and massive overpayments isn't there, it might be you've got enough cash every single month or even a lump sum to help you when you remortgage, help you drop down to the next level of loan to value, the next level of mortgages, and reduce that rate. And the final pro, the other thing to think about when overpaying your mortgage is it could be that if times are good right now and you've got that spare cash and you overpay on that mortgage, it gives you that greater flexibility as well if things aren't going so well, if you need to sort of claw back because you've got more money in the property, more money has been paid into that mortgage, that loan has got reduced at a faster rate than that initial terms suggested. So you've got that potential there to talk to your lender and maybe reduce your main payment, your normal payment over time, if even that becomes too much, let alone an overpayment. But because you've done this when times are good, that hopefully gives you a bit more flexibility. So all sounds good, right? So you've already worked out whether you've got debts, you've cleared them, you've worked out if you've got emergency savings, you've worked out whether you want to go with investing versus overpaying the mortgage. All of those things come into play. Now, how do you do it? Okay, so I think if it works out, it's a good thing for you to do. How do you go about and doing it? Well, there are a few different things to bear in mind. One of them is probably the most important thing is, are you allowed to do it? Because not all mortgages have that facility that allow overpayments at all. If you do it, you could get hit with a charge, get hit with a penalty. So you want to make sure that you're allowed to do it. You also need to make sure if there's a cap. Quite often, if there are overpayments allowed, there's a limit. Maybe say it's 10% of the total amount you owe is allowed to be made as an overpayment, and that could well be on a monthly basis, on an annual basis, whatever it is. So you really need to make sure that, again, there isn't a cap. Now, I'm very lucky, well, I'm not lucky. I deliberately chose mortgages. Both the two mortgages I have, I chose them to make sure I could make as many overpayments as I wanted whenever I wanted. That was really important to me because I always knew if I could, I wanted to do that and clear that mortgage early. Now, with the mortgages I have, one of them I said I'd say is this tracker. That's that 25-year one, 23 years left on that. That one, I can make as many overpayments as I want. And when I do that, I can close that mortgage whenever I want. The 10-year one, though, that is slightly different because although I can make as many overpayments as I want, if I was to clear that entire amount within 10 years or earlier than 10 years, there will be an early redemption fee. So I would hit by a charge. So although I'm going to make overpayments on it and higher overpayments on that part of the mortgage because that one is at a higher rate of interest than the other one right now, I'm going to pay more of that one off than the other one early. I'm going to make sure I don't do it before the end of the 10 years. So I'm going to time it to finish on the 10 years. If I do it 9 years, 8 years, whatever it might be, if I paid it off early, then I would be hit with this extra charge. So you need to make sure that all those sort of factors, how that affects the mortgage that you have, The best way to do that is to get on the phone, call them up and just find out exactly what the details are. Now you might have the paperwork as well that will be in there, but I would phone up and just double check exactly what the deal is. You also want to make sure how they can let you make those payments. Now for me, it's really easy. I can simply set up a standing order and pay it into the account, or I can have those details as well to make a single payment as I go along. It might be different for you. So to make sure you understand exactly what the process is for you, and make sure they know that when you're making these payments, these overpayments, that you are putting it to build down that loan and pay off that loan and reduce it as much as you can. And it is an overpayment. You don't want them to go through a formal process where what they do is just increase your standard repayment to a certain amount, which in turn will reduce the term of the mortgage. So let's say it was 25 years, but you paying a little bit extra, it brings it down to 20 years simply by formalizing this overpayment. If you do that, although essentially if you can carry on making that payment and that overpayment every single month without fail, there's no real difference. What it does do is reduce that flexibility that I spoke about, because all of a sudden you have got a higher payment that you have to make every month, otherwise you will default on that mortgage. Much better to have that flexibility where you have, this is the amount you have to pay, and this is the amount extra that you want to pay. Doesn't make a difference really in terms of when you complete it and when it actually, paid off completely at the end, but it does make a difference in terms of that flexibility. Now, when you're doing this as well, you've got options. So you can make a monthly payment if you want. You can do it every single month. You can set up a standing order so it goes out of your account whenever you want. That's a really good way of doing it. I would say make sure that when you are making this, that your bank balance, whatever account you're using, you're going to have the cash in there to cover that overpayment. Yeah, it's really simple, isn't it? But what I would do, the way to do this, and I do this for a lot of stuff, but I have a separate account that is just for my mortgage. Okay, nothing else goes in and out of that account, but I transfer from my main bank account the amount of money that I want every single month into that account, and then that money then goes and pays off that mortgage. Keeps it completely separate. There isn't that risk that the money in my account, other things come along and the money gets spent. None of that, no. It's all completely separate, okay? So I would do something like that as well. You also need to be really careful here as well of the type of mortgage you have as well. Most of you are going to be on what's called a repayment mortgage, yeah? That's great. Sometimes you might be on something called an offset mortgage. Now, an offset mortgage is slightly different. Although you are paying off your money on your equity with your payments every single month, you've also got savings which offset the total amount that interest is charged on. So for example, let's say you owe £100,000 on your mortgage. If you have 20 grand in savings, what it would do is only charge interest on that 80% that isn't split off by those savings. So it's a way of bringing down how much interest is charged every month. Essentially it works in a similar way in lots of ways. Often though there are higher interest rates attached to those than the more normal mortgages. So just make sure you haven't got one of those. If you have, it might not be the best thing for you. And also, this is, probably should have touched on this at the top. If you are on an interest only mortgage, even more so, if you're allowed to make payments, extra payments every month, you should be doing this. Now, interest-only mortgages are a lot rarer now, but people still have them, a lot of them out there. Now, this is where you don't make any payments at all on that loan at all. You're not building the equity up in any way. All you are doing is clearing off the interest, which is added every single month, okay? Now, that might be a good thing for you when you got it. It might have been all you could have afforded. But ultimately, when that mortgage finishes, you are not going to own anything at all, okay? You will not have any property to fall back on. So if you have that ability right now, try and clear down that equity as well as paying the interest every single month. And when you come to remortgage and get a better deal, try and get onto a repayment mortgage away from an interest only one. It can be difficult, but the more equity you've built up, the easier that is going to be. Well, there you go. Hopefully this video has given you the insight you need to know whether you should be making overpayments on your mortgage or not. Head over to becleverwithyourcash.com or check out the links below the video for some tools that will help you work out just how much money you can save by making overpayments and how fast you can possibly clear that mortgage completely, as well as other tips and tricks to help you on your way. Until next time, cheers.